Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're diving into 3 dividend-paying stocks that investors might want to consider buying amid the continued coronavirus uncertainty and market volatility. But before we get into everything, I want to say remember if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. And make sure to also check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. So I'm going to start with what's pretty much the obvious at this point. The stock market continued to plummet last week, and it fell into a bear market at light speed. But Thursday's big declines, which saw all 3 major U.S. indexes fall over 9%, with the Dow down 10% for its worst day since 1987, did see a big bounce back on Friday, where the market regained a lot of those losses they saw on Thursday. However, that did not last long. After stocks then tumbled Monday morning, all trading was halted for 15 minutes within seconds of the opening bell, prompted by a more than 7% drop in the S&P 500. This was the 3rd time in 6 sessions that the U.S. stocks had been halted intraday. Before March, the last time this happened was 1997. And as of about Monday morning, so through Monday morning trading, indexes were down around 7%. They had fallen over 10% at one point, but the volatility continues to be up and down. So by the time you're listening to this, things could have completely changed. And this all came after the U.S. Federal Reserve slashed its benchmark interest rate to near zero on Sunday. The Fed cut rates for the 2nd time in an effort to help the economy battle through the coronavirus impact. But now some are worried that they can't lower the rates anymore. So what will they be able to do? On top of that, the central bank also did note that they will buy at least $500 billion in Treasury securities and $200 billion in mortgage-backed securities starting Monday, so today, and continuing over the coming months to help unclog the markets that have grown relatively dysfunctional in the last week or so. And meanwhile, investors are clearly starting to become more and more worried about what companies are going to do amid all of the coronavirus uncertainty, and social distancing has now turned into a complete close down of all large public gatherings. The CDC is now calling for all events of 50 people or more to be canceled for the next 8 weeks. And then over the weekend, there was some big news from some really big companies, including one of the biggest companies in the world. Apple announced that it will close all of its retail stores outside of Greater China. Apple said that it would close these stores until at least March 27th in light of the worsening spread of the virus. They did note that hourly workers will continue to be paid, and investors should note that estimates suggest that about 8% of Apple's sales occur at physical retail stores, and this is according to a weekend Wall Street Journal report. And then alongside Apple, we saw Nike, Abercrombie, and some other big retailers decide to close shops as well. But we should note that Walmart and other grocery-related stores have remained open and will continue to restock. And with all that said, the situation is changing rapidly, and now more people have died from the novel coronavirus outside of China than inside, according to the latest Johns Hopkins University data. And we now have more cases of the infection outside of China as well, where we have over 93,000 outside of China, where we have about 81,000 cases inside China. So with the market downturn and interest rates so low, obviously investors are clearly going to be looking for some safe haven style investments. So today we're going to be diving into 3 strong stocks with strong dividend yields that might be worth buying or at least putting on your watch lists at the moment. And we're going to start with Broadcom. And this trades under the ticker AVGO. And the basic pitch is Broadcom sells semiconductors that go into cell phones and networking equipment. And more recently, they've expanded into infrastructure, software solutions. And a lot of this has been through acquisitions. We should also note that Broadcom has reached a new multi-year supply agreements with Apple to provide wireless components through 2023. So the new 3.5-year agreements come after the firm landed a separate deal last year to supply Apple with radio frequency units. So in total, these deals could bring up to $15 billion in revenue to Broadcom. And it's also good to note that Broadcom has extended its ongoing relationship with the global smartphone giant because Apple is slowly trying to move more and more of its chip making in-house. So it's good sign for Broadcom. And also last week, Broadcom kind of helped investors in Wall Street understand what's going on with this coronavirus and all this uncertainty because they reported their Q1 fiscal 2020 financial results after the closing bell last Thursday alongside Adobe and Oracle. And their adjusted Q1 earnings did top our Zacks estimate while revenues fell short, but people didn't really seem to care much about that. It was more that they are now pulling their full year 2020 financial projections due to the coronavirus, saying, quote, "We did not see any material impact on our business due to COVID-19 in our first quarter." And this is from CEO Hock Tan. However, visibility in our global markets is lacking and demand uncertainty is intensifying. As a result, we believe it is prudent to withdraw our annual guidance until visibility returns to pre-COVID-19 levels. So in general, they're just saying, we don't know what's going on. That's kind of a lot of what's happening in the market. The sell-off is happening because obviously everything's closing and supply chains have been severely impacted in China. And now we just don't really know what's happening. And that is what Broadcom has laid out. So we should note that the company did provide Q2 sales guidance of about $5.7 billion plus or minus $150 million. And investors should note that that guidance did fall short of our previous estimate, which would have marked about 7% top line growth. And along with that, as one might expect, Broadcom's consensus earnings estimates have now slipped for Q2, as well as fiscal 2020 and fiscal 2021. This helps Broadcom hold a Zacks rank number 3 hold at the moment. But longer term, and obviously these estimates are fluid, and this could change as more estimates come in and as Broadcom lays out more of a plan going forward. Their revenue is expected to climb over 10% this year and another 6.4% next year. And then their adjusted earnings are expected to climb about 7.5% this year and 10.6% in the next year. And along with their expected growth, Broadcom's management had already raised its dividend by 23% in fiscal 2020 to $3.25 per share per quarter. And the dividend yield currently sits at a really strong 6.5%. This blows away the 10-year U.S. Treasury, which was hovering at about 7.9% Monday morning. And this also comes in well above the S&P 500's average of about 2.1%. And this is based on the Spider S&P 500 ETF, which trades with the ticker SPY, SPY. And it compares really favorably to big companies such as Apple, which is currently paying out a yield of about 1.2% at the moment. So Broadcom's 6.51% is really solid. And the company also is part of our electronic semiconductor industry that rests in the top 12% of our more than 250 Zacks industries. And obviously, we should note that their dividend yield has been lifted by the stock price falling. In fact, it touched a new 52-week low on Monday, down 15% on the day through morning trading to around $199 per share. And we should note that the stock was trading all the way up at $325 a share in mid-March. So that's about a 40% haircut in the last month, which might actually make it attractive to investors. So its dividend yield is high, and it's now trading right around new 52-week lows. And any longer-term investors might want to consider scooping up this semiconductor firm who is a big Apple supplier at these new 52-week lows. So now we're going to move on to another company that's paying a solid dividend yield at the moment, and that is AT&T. And their pitch to investors remains pretty straightforward. AT&T is in the midst of a transformation for the cord-cutting age. This includes its $85 billion Time Warner acquisition, which they completed a couple years ago. And then the telecom giant is set to roll out its HBO Max streaming TV service in May to help compete alongside Netflix, Disney, Amazon, Apple, and others for the future of entertainment. And meanwhile, AT&T's broadband internet business looks poised to grow, and it's ready to roll out its 5G business more quickly alongside Verizon and the newly merged T-Mobile and Sprint. So that's that next generation of wireless service that's all you hear about. So the next several years, that will be a big part of AT&T's business as well. And jumping back to October of 2019, we should note that AT&T reached a deal with activist investor Elliott Management, which is going to see it commit to further cost-cutting measures and stock buybacks as it continues to pay down its debt. And then on March 10th, AT&T's CFO, John Stevens, updated shareholders about everything from buybacks to the impact of the novel coronavirus. He said that under each of the two outstanding accelerated share repurchase programs, AT&T will retire about $4 billion in common stock. And then this is a quote from a release saying, depending on market conditions, the two ASRs, which are the accelerated share repurchase agreements, combined with open market repurchases, are expected to bring down total common shares retired in 2020 to more than 250 million through April. And then the company also noted that they don't expect to be significantly impacted by the coronavirus. And obviously this can change. This was back on March 10th. And he said that while, quote, he can't speak on behalf of any specific supplier, the company hasn't seen a significant impact in its supply chain at this point. But obviously things are changing very rapidly. So this could all be outdated information for AT&T at this point, and we might not know until they report their results or come out with a new release. So we should note, though, that the stock is down around 20% in the last month, along with a lot of the market. As of Monday, they were hovering at around $32 per share. And this recent downturn has boosted AT&T's dividend yield to about 6.33%. This easily tops its main rival, Verizon, which is its yields at about 4.7% at the moment, and it's one of the stronger yields among tech and telecom firms in general. Like Broadcom, AT&T is currently a Zacks rank number 3 hold based on some of its mixed earnings estimate revision activity, but it does hold B grades for both value and growth in our style score system. So looking long term, AT&T might be worth buying, or at least considering at the moment, for its dividend yield, its continued buyback efforts, its streaming TV push, and its 5G future. So certainly AT&T is a big company that some people might want to scoop up at relatively near its 52-week lows as well, with this solid 6.33% dividend yield as well. And then we're going to close out with IBM, the historic technology giant. So IBM signaled to Wall Street earlier this year that it is really committed to its cloud computing transition when it announced in late January that its longtime CEO, Jeannie Rometty, would step down, and taking over as Arvind Krishna. He will be taking over IBM, which he had previously held different roles within the company, and he had helped the company sort of transition already to this cloud business. So prior to his transition, the company had announced on January 21st that it also beat quarterly earnings estimates, and it posted surprise Q4 revenue growth. And this was after 5 straight quarters of declining sales. So we should note that overall their cloud computing revenue climbed 21% last quarter to account for over 30% of total sales. And on top of that, their Red Hat sales jumped 24%. And this is helping some maybe on Wall Street justify why IBM acquired the open source software firm for about $34 billion. And as we mentioned a little bit earlier, the CEO who's set to take over, he's already played a key role in turning the company's focus to cloud and artificial intelligence and quantum computing for this big data era. And looking ahead, IBM's revenue and earnings are still expected to climb in fiscal 2020 and 2021, with even bigger growth expected on the bottom line. And overall, their earnings revision activity helps the stock remain at a Zacks rank number 2 buy at the moment. The firm also holds an A grade for value. And IBM's dividend yield sits at about 6.26% at the moment. This easily tops Qualcomm, which is yielding at about 3.5%, and fellow tech giant Microsoft, which is yielding at about 1.4%. So this 6.3% dividend yield is really solid compared to what you could call some of its peers in the tech space. And overall, IBM stock is now trading at about $102 per share. This is down, once again, 35% from its early February highs of around $155 per share. And it's really not too far above their lows at this point. So amid all of this, all three of these stocks have fallen relatively significantly. This has helped boosted their dividend yields, which just goes along with the territory. But also, they remain relatively solid longer-term investments. So any longer-term buyers really might consider buying any of these stocks we've talked about today. So that's AT&T, Broadcom, or IBM, not only for some dividend yields amid this uncertainty with interest rates so low, but these longer-term investors really might consider buying any of these stocks on what would consider a discount at the moment. Obviously, the uncertainty remains and stocks could continue to climb. So don't do anything you feel uncomfortable doing, because as this coronavirus continues to spread in the US and elsewhere, things could get worse before they get better. But obviously, things have been hammered so hard so quickly that maybe they're already at discounted rates that are attractive to investors. But that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.